Good morning and welcome to the December 2022 UCLA Anderson Forecast Conference, where we're going to talk about recession or no recession, and we're going to be talking about digital currency and cryptocurrency. So we have a really exciting program today. And with me up here is our forecast team. We have Ed Leamer. Ed has been here at UCLA for a while and mentored many students and had many years as my predecessor as the director of the UCLA Anderson Forecast. William Yu, who it's okay to say you've been here 11 years, right? And William came to us from teaching in Minnesota and graduated with his PhD from the University of Washington. And Leo Feller, who leads our US forecast team. Leo graduated from Brown University and after a stint with Johns Hopkins and Boston Consulting Group and Cornerstone, joined us here at the Forecast. We have and I didn't introduce myself, I'm the faculty director of the UCLA Anderson Forecast. I'm Jerry Nicholsberg, and I'm going to be your master of ceremonies today. We have the first part of our program. We're going to be talking about the U.S. economic outlook and the California economic outlook. We're going to start with Ed, and Ed is going to talk about recession and how do you understand in a data-based way when we're going to have a turning point in the economy. And that's really the hardest job that we have as forecasters, or anyone as forecasters, is where are the turning points. So Ed's going to show you how we think about that. That leads us to something that is going to be different from what we usually do. Usually we'll give you a forecast and talk about the risks. Today we're going to give you two forecasts, and then kind of at the end of the forecast program, talk about how you might think about those two and compare them. And we're doing that because there's a great deal of uncertainty in today's data, because in this post-pandemic world, things really are different. That's going to show you about that. Then Leo will follow with the US forecast, tracing out what those two scenarios look like. That's going to flow down to the California forecast, and I'll go through that, and then we'll try and pull that together. We'll have a little time for Q&A, then we'll take a break. Then we have a really great program on digital currency and on cryptocurrency. We had to kind of call it audible yesterday, so your program is not exactly correct. Two of our speakers are unfortunately unable to make it today, but fortunately the bench is very deep. And so Arif is going to do a presentation from the IMF's view, the International Monetary Fund's view, on central bank digital currency. And we'll move from there right into our panel to talk about cryptocurrency, what's happening and what might happen and what that landscape is. The other person who unfortunately can't be with us today is Laurie Sentikian, who is the faculty director of the Fink Institute for Finance here at UCLA. So I'm going to be stepping in on that and moderating the panel. Before we get started, first of all, would like to thank the Fink Institute, Laurie, and all the great people there. We're partnering with them in this conference. And secondly, what I'd like to do is thank Steve Gordon and Dick Simon for their special support of the forecast with respect to the work that we do in real estate. And thank Edison International and Southern California Edison for their support of our Forecast Fellows program, a program that provides pathways for students from underserved communities into graduate school. And we're partnering with Cal State Dominguez Hills in that regard. Next, what I'd like to do is thank our sponsors. We are a public institution. We couldn't put on these programs without the help of our sponsors, and so we're very grateful for their support. Our principal sponsor today is RSM. Our platinum sponsors are the law firm of Allen Atkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. And by the way, University Credit Union actually started here on the campus of UCLA. So it's really a pleasure to be partnering with them. And at the gold level, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, ventured forward by GoDaddy, Pacific Western Bank, Robert Half, and United Airlines. At the silver level, Pathway Dinwiddie, Scott Work North America, Union Bank, the private bank, and Valley Bank. And at the bronze level, Dub Value Creation, EY, HGR, Hanley Bank, InstaWork, Marsh McClellan Agency, and at the Bruin level, Gerber Kawasaki Wealth and Investment Management, and our academic sponsor, of course, is UCLA Extension. Many thanks to all of our sponsors, and I think as we are about to begin a new year, if you didn't hear your company's name on here, we can fix it. And we'd be happy to fix it. And finally, before we jump into our program, I want to thank two people who are on the staff of the UCLA Anderson Forecast, Seth Katz and George Lee. These folks work incredibly hard to make this a great program. Things that you don't see, but it is really valuable in the programs that we put on. So thank you to our staff. And with that, I'm going to turn it over to Professor Ed Leamer to talk about how we think about these turning points and what does the data tell us.
Okay, thank you very much. I guess you can all hear me. I'm not going to give the forecast. We're going to make the forecast together. I want you to see how it all operates, and you can decide whether I've got it right or not. And the first thing we're going to look at is the slope of the yield curve, which is the interest rate on 10-year Treasury minus the rate on the 3-month Treasury. Normally, you get paid more, a higher interest rate on a 10-year, but occasionally you get this inverted yield curve in which the 10-year yield is less than the 3-month yield, which is exactly the way it is right now. And inverted yield curve is usually thought of as a predictor of recession. So you're going to see in this image the yield curves that have occurred, in 7 expansions historically. The most it says 36, 24, 12. That's the months before the next recession. I'm going to stick in one episode. That's the episode that ends in 1957 in August, where the circle is around that legend at the bottom. And that's the yield curve that occurred in those 36 months back in the 50s. And you can see that the yield curve was fairly steep, meaning that the spread was above 1% in 3 years before the recession. And then it's more like 0.5% in the year before recession, and then maybe a little lower in the year before recession. So it's already suggesting that a flat or inverted yield curve might indicate that a recession is coming. But that's just one of 7 episodes. And I'm going to stick in the other episodes. And that's the 1969 event. One thing that's interesting is at the far left, there's an inverted yield curve, meaning a negative slope of the yield curve 3 years before 1969. That was in 66, where the bond market was flashing out warnings. Those warnings were offset by the ramp up by the Department of Defense spending on the Vietnam War. So the recession that was being signaled by the bond market didn't actually occur. But I would say the warning was legitimate, even though it didn't produce a recession. It didn't create a recession. It was falling. But again, you see the yield curve inverting in the 3rd month before. That's the Burns episode, where Arthur Burns was the chair of the Federal Reserve, over here on the right, and created a deeply inverted yield curve. more than a full percentage point difference between the 10-year treasury and the 3-month. That's the Volcker period. Ending in 1980 in January. And those black dots indicate the period of time when Volcker was actually the chairman of the Federal Reserve. He didn't take over until the end of that. But he too, like Arthur Burns, created an equally inverted yield curve immediately before they had a recession. And that's the 1990 event. And I don't know if you can see it, but it never got inverted. So that's a case where we had a recession, one step beyond the right edge, without having an inverted yield curve indicate that the recession is coming. And that's the 2001, and that's the latest one of 2007. You can see there the yield curve occurred a full year ahead of time. It wasn't an immediate year before recession, but a full year. And then as a way of summarizing it, that's the mean of all those 36 observations. Every mean by month by month. You can see the mean is indeed getting flatter and flatter until the very end. There's a negative about 6 months out, and then it starts to improve. The reason is the Fed is saying, oh my God, we made a mistake. We've got to reverse this outcome and start raising interest rates again. But until then, the Fed is the one that's in control of the yield curve. So then the question is, what do we do with the most recent data? How do we insert that into this image? And we're going to take the 12 months, we're going to put it where it belongs most compellingly. That's your job. I'm going to do it for myself. And there it is right there. That's the little diamond. You can see there's really two kinds of episodes. Whoops. Oh, no, here we go. There's the last 5 months have had pretty flat yield curve, and it ends in November with an inverted yield curve. That's the last little diamond on the right-hand side there, or triangle, I think. But it's also in earlier period of time in which the yield curve was rather steep. And if you look at this, that incredible drop in the slope of the yield curve doesn't at all well conform with the means. The means are kind of smoothly moving down to the right. But if you let your eye move a little to the right of where where those triangles are, you'll see the orange. That's the Volcker era. So let's eliminate everything, just use the Volcker era and see what that looks like. So this image, and that's the Volcker at the end where he gave us a deep inverted yield curve. That's where my algorithm wants to place that 12 months. But you can see you can move it a little bit to the right, and then it would replicate the Volcker era. So if we use that as evidence about where we are now, we would say, well, if Volcker had a period of quietness where he didn't feel he needed to create a terribly inverted yield curve, he's waiting for the inflation problem to cure itself. And that could be what happens now, where the Fed says, look, we've been raising these interest rates crazy. Let's give a little time out and see what matters. But for Volcker, the inflation got totally out of control, so he had to create a terribly inverted yield curve. That's just my way of saying, I think I got the placement about right. This is an algorithm that does placement. It's a little bit to the left of the Volcker era, but not so much. So that placement is done econometrically, and it produces an outcome and a probabilistic allocation of that last month of the most recent 12 data among those 36 options. And another day I give a lecture about how this all works out, but that algorithm produces a number of 71%, 71% chance that that's 12 months ended in the 16th month before the next recession. In other words, it says the recession is probably more than a year away. And that's being pulled back by the fact that we've got those pretty high, pretty steep yield curve in the first 6 or 7 months of the last 12. But if you just focus on the 2 months, then it says there's virtually a 30% chance that we're in the last 6 months of the data. And the reason is those last two months, here's the picture again, The last 2 months at the end are when the inverted yield curve occurred. So that's ringing out a very alarm bell, well, not alarm bells, but the early months say, probably a year later. But the yield curve is so steep at that point. And then, so this is a summary of what my algorithm produces. It produces probabilities for every 6 months, the most recent 6 months, the next 6 months, and there are 6 of them in a 3-year interval. And then I do it for based on a 1 month data alone. And it says there's a 41% chance that we're in the second 6 months away from the recession, but a 38% chance that we're in the last 6 months of expansion, that the recession is imminent, or pretty high probability that we're late. But if you move up to 2 months, it says 57% chance that we're in the last 6 months. But if you move up to 6 months, you get 69% that we're a full year or more away from it. And the reason is, once you add that 6 months, you add the old data again. So I'm just trying to give you a sense that there are 2 outcomes implicit in that yield curve. The outcome that depends on the steep yield curve that was 6 to 12 months ago, and then the outcome that the Fed is induced with the inverted yield curve. And then if you use a full 12 months, it says that it's an 80% chance that we're more than 1 year away from the recession. So that's that. What about inflation? So here you have the image of inflation. There's a period of high inflation, and then it gets softened. There's two episodes in this event too. That's one of the, my algorithm is sort of different between placing it where you see it here and placing it a little bit farther to the right. But the essential point again is there's 2 kinds of episodes. And if you look at these, the graph, all these inflation periods, you don't see a reversal in inflation rate. It looks like you got to get to the end when the inflation occurs in order to have any kind of control over inflation. If you look at the 1970 so-called stagflation period, you'll see that the Fed had no impact on inflation until unemployment rose. So the takeaway there is the Fed doesn't matter with this higher interest rates. It might have an impact on your purchase of homes and cars, but it doesn't cure the inflation problem until you put people out of work. And then you get a fear of inflation. Anyway, so here's the unemployment rate. The thing is that at the far right, the unemployment rate is nice and low and pretty steady. So it looks like the labor market is doing great. And that's a symptom that you're in at the end of the 3 years. Earlier, the unemployment rate tends to fall. Well, here at the average is falling. Those big circles that represent the average, they're falling until you get over here on the right, and then it's flat. So the low interest, low unemployment rate that we're having now. Oh, by the way, there's a little tail. I got those triangles, but I got some squares. The squares represent the actual data, but that's the COVID-19 period. And COVID-19 has destroyed the meaning of historical meaning of what we have. So I eliminated COVID-19 in order to produce that the unemployment triangle. And that says a recession is imminent, only 6 months away. Here's housing starts. Housing starts are issuing a big alarm. We're having declining housing starts, which is a very clear indicator that here in the last 6 months of or last year of the expansion, very clear statement about that. You all agree with that picture. And the other one is average weekly hours of manufacturing. The thing about the manufacturing sector is when demand is weak, they don't initially fire workers, they put down the overtime hours. You can see this is average hours per week. The vertical scale is 40 hours, 41 hours. So over here, we started last year, that's a triangle. We started this last year with a lot of overtime in manufacturing, with an average work week of 41.5 hours. And then that's been declining ever since, a symptom of weakness in manufacturing. So that's ringing out very loud alarm bells about the immediacy of the recession. Housing and the two Main Street items, which are housing and manufacturing, they seem like they're in recession already, those seeing. The question is whether that's going to affect the rest of the economy, and if so, when is that going to occur? So here's my forecast, mix them all together. And on the left-hand side, that's the spread. That's the data analysis based on the spread. Inflation, unemployment starts, and housing, manufacturing. And then on the far right is combining them all into one. Okay, so let's start on the tall greens. Those are the data series that are signaling that we're within 6 months of the next recession. And we just went through them. That's inflation, housing starts, and hours in manufacturing. Green means 6 months away. And those time series are all supporting the conclusion that's only 6 months away. But the two that think differently are the spread, which very strongly says we've got a whole year waiting to occur. And you're not going to have a recession until a full year ends. And then unemployment says maybe we're in 6 months or maybe we're about a year away, but it puts a significant probability on that as well. So you've seen the pictures, they're kind of mixed message. That's why it's logical to me when Leo's going to talk about alternative scenarios, because we don't know really which way this is all going to go. But if you use the combined rate, it says that it's a yield curve that dominates. And we're going to have to talk about econometrically, how can that possibly be, and how can the combined analysis ignore the unemployment that starts and housing and manufacturing? We'll talk about that later on, but that's where the algorithm works. That produces that conclusion. But the things that I worry about are the Main Street variables, which are housing and manufacturing. And this is an image of housing starts, the log of housing starts. So the numbers 7.2 and 7.6, that's like the log of 1.5 million. That's the black lines that are going up and down the housing starts. And that blue line represents the rate of growth of population over the last 3 years, the people who need to have homes built in order to house them. And that's a nice smooth series. And you can see the overbuilding and underbuilding. There's a period of terrible overbuilding in the early 2000s compared to the population needs, but that was more or less completely offset and more than offset by the big decline in housing starts after that. So we've had what looks like overbuilding, but not a whole lot. So the housing sector doesn't have the terrible overbuilding, doesn't have the financial sector problems of all the subprime loans that went to individuals who couldn't afford it. So it doesn't seem like you're going to have a very serious housing crisis, is what I would say. And what about manufacturing? Well, this shows you the share of the workforce in manufacturing, which back in the 60s was something like 30 or 35%, and now it's only 8%. This, by the way, is my explanation of why we're having an attack on our democracy. If we built our democracy in our factories, that's where you had a good job if you had a high school education. And lots of communities were very reliant on manufacturing. And we've let all those things disappear without any concern about the communities that were left behind. Those communities were really annoyed with, especially the Democrats. But with manufacturing only 8% of the workforce, that couldn't mean a big recession, could it? So although housing and manufacturing are signaling a problem, it's not a really deep problem. So I think that the Fed's rapid inversion of the yield curve says we're going to have a recession in about a year. It looks like Volcker choices. We'll see how Jerome Powell responds. So he follows the Volcker rule about the Volcker choices. Get close to it. COVID-19 has confused the use of the unemployment data, but you get rid of that stuff. It says we're in the big problem. Housing is a problem, and manufacturing as well. So the conclusion is, a kind of vibrant outcome. But the latest news in the papers is all about the tech sector laying off workers. So I wondered, what about if I create my image that shows what the tech sector is doing, which is this image, this is the information sector. And you should immediately think, take a look at this, is this totally unlike what you've seen before? Because these are totally flat. Jobs in the information sector are completely flat. So this is not an indicator of a recession to occur, at least if you look historically. But Leo asked me yesterday, proposed implicitly the point that we, looking backward, that's the industrial age. Looking forward, that's the post-industrial age. And that means that the things that we've seen in the past are not necessarily a good indicator of what's going to happen in the future. It could be that the cycle will be driven in the future by the tech sector, not by housing and manufacturing. We don't have enough data yet to answer that as a possibility, but certainly it seems like a possibility. So in conclusion, the big area is hard to see.
Good morning. So, given that the future remains hard to see, we are going to present you two scenarios, and then Jerry is going to summarize some probabilities on these scenarios. So, the two scenarios are Goldilocks or bust. And the Goldilocks is a reference to David Schulman, who wrote this 1992 article called The Goldilocks Economy. Remember Goldilocks and the Three Bears, right? There is a just right, condition that causes us not to have a recession. Or the question is, well, will we actually have a recession? So let me start off with why we have so much uncertainty. And that stems from the Federal Reserve having policy uncertainty, and that leads us to have forecast uncertainty. And this is a quote, a long quote from Chair Jerome Powell from a speech that he gave November 30th. And he says, look, monetary policy affects the economy and inflation with uncertain lags. The full effects of all the monetary tightening that have already happened, it's going to take a while for us to see the effects of that. And so it makes sense to moderate the pace of our rate increases. Right? So that suggests this pausing of interest rate increases that Ed had pointed out that also occurred during the Volcker era. The moment that Chair Powell said this, the stock market rallied. Interest rates on bonds fell, right? Financial conditions loosened. And then he also says, given our progress in tightening policy, the timing of that moderation is far less significant than the question of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time. History cautions, and again, going back to the chart that Ed shows, history cautions strongly against prematurely loosening policy. The problem is that every time that Fed Chair Jay Powell says, look, we're going to pause and moderate on rate increases, the financial markets automatically loosen financial conditions, right? The interest rate on bonds come down. So any sign of a hopeful pause leads financial conditions to loosen, which is the exact opposite of what the Fed Reserve wants. And so this becomes a game of, do you have to keep increasing interest rates? Not because that's the right thing to do, but because if you pause, the markets suddenly react and loosen financial conditions. So we present two scenarios. In green, we have the no recession scenario. In that scenario, the Fed pauses after increasing rates 50 basis points right now in December. And then that's it, right? That's the end of the tightening cycle. And we get a terminal rate of between 4.25 and 4.5%. We assume that inflation supply constraints are going to ease. We assume that there's going to be some modest increase in unemployment above the natural rate of about 3.9 to 4%. It's enough to ease pressure on inflation, but not enough to force a decline in consumer spending. So in this case, unemployment goes up, but it's a little bit of an increase, and it's not enough to cause consumers to really retrench. What Larry Summers called a Wile E. Coyote moment, where if you remember Wile E. Coyote from Warner Brothers, right? The Wile E. Coyote running along and suddenly falls off the cliff, right? So in this scenario, there's no falling off the cliff of consumer spending. So we expect consumer spending to remain resilient, businesses to continue investing because consumers continue to spend, and we don't really expect much more of a decline in home construction. That's the no recession scenario. In red, I'm going to show you the recession scenario. And in this scenario, the Fed has to keep increasing rates up to 5.5 to 5.75%. It reaches that terminal rate in mid-2023. It then causes the economy's in a recession and the Fed starts cutting rates in 2020. We get less easing of inflation naturally in this scenario. Inflation does ease, but that's because the Fed Reserve is forcing higher unemployment, is forcing lower consumer spending, and that's what causes inflation to come down. It doesn't come down on its own. In this scenario, unemployment peaks at about 5%, which is enough to force a decline in consumer spending. So we get a little bit of a Wile E. Coyote moment where consumer spending falls. Consumers cut back, businesses also cut back. We get further declines in home construction and financial conditions, but the recession is relatively mild and short-lived. Let's go through these two scenarios. I'm going to start off showing you annual rates of growth, annualized rates of growth. And that's because this is often what we hear in the press, right? So for those of you who follow the Atlanta Fed GDP now, they have this current quarter at a 3.4% annualized rate of growth. The economy is still growing strong. We added 263,000 jobs. On an annualized basis, we're still doing pretty well. The recession scenario in red has us declining to about a negative 2.7% annualized rate of growth in the third quarter of 2020. In the green, the no recession scenario, we get a slowdown in growth. We get that one little quarter in Q2 where we get a negative 0.2%, that's basically zero, right? So we're flatlining in the second quarter, and then things pick up again. A different way of showing this is to look at what happens on a year-over-year basis, right? So year-over-year right now, the economy has grown 0.9% above where we were in Q4 of 2021, right? So we got a little bit of growth this year. In the recession scenario, this comes down. And by the end of 2023, we're down 1.2% from where we are today. In the no recession scenario, we're up 1.2% from where we are today, right? So even in the no recession scenario, this isn't a spectacular, year of growth in 2023. 2023 is hard regardless. It's do we grow 1.2% or do we shrink 1.2%? And importantly, the delta between these two scenarios is 2.4%, right? So this is in the but-for world. If we did not have a recession, what would the world have been like? Well, it would have been 2.4% more than in the recession. What does this imply for the levels of GDP, the level of economic activity that we have? So in the no recession scenario, we muddle along, we're kind of moving flat in early 2023, and then growth picks up again. In the recession scenario, economic activity declines. We reach the trough of economic activity at the end of 2023. And then the red and the green line are parallel. We're growing at about the same rate, right? We're kind of closing the gap, but very slowly, not until the end of our forecast horizon into 2025 and 2026, would it be the case that there's no difference in economic activity between the recession and no recession. I'm going to show you a few charts. This is showing what happens to consumption, right? Between the recession and no recession scenarios, consumption declines. This is what consumers are doing. Consumers are pulling back in the recession scenario. It's about a 2% drop from where we would have been if a recession had not occurred. But businesses also cut back on investment, right? This is the bigger decline. It's businesses and household investment. That declines by about 4.5% from where we would have been had a recession not occurred. And then in terms of unemployment rates, you can see that in the recession scenario, we peak at about 5%. In the no recession scenario, we peak at about 4%. So in both scenarios, we get an increase in unemployment. And in part, that's related to what Jay Powell has referred to as an unhealthily tight labor market. Right now, we are at 3.6% on a quarterly basis. We're at 3.7% unemployment as of the November jobs report. This is, according to the Federal Reserve, leading to higher wage growth. And that higher wage growth is feeding into higher inflation. And so the thought is that 3.6 or 3.7% where we are today is too low of a rate of unemployment. It's such a low rate of unemployment that it's allowing workers to be able to negotiate higher wages, negotiate better benefits, and that is causing prices to increase and be passed on to in terms of higher prices. So some of the rebound, some of the increase in the rate of unemployment is just getting back to maybe this natural non-inflationary rate of unemployment, which might be around 3.9 to 4%. We don't really know what the non-inflationary rate is. What we do know is at 3.6%, we have high inflation. And so some of the increase coming back is just to get us to be at a low rate of inflation. Maybe we have to go a little bit beyond that to the 4.3% in the no recession scenario to really stamp out inflation. In the recession scenario, we have to go all the way up to 5%. The way that this gets accomplished is through the federal funds target rate, right? So the federal funds has its benchmark interest rate. In the no recession scenario, as I mentioned, we get one more increase right now of 50 basis points and then no further increases. That's the terminal rate. We end at about 4.4 to 4.5 or 4.25 to 4.5%. In the no recession scenario, the Fed then holds that rate through the end of 2023, and then it starts bringing rates down. In the recession scenario, the Fed continues increasing rates, right? This is the yield curve getting more and more inverted that Ed Beamer pointed out. And in this scenario, the Fed takes rates all the way up to 5.5 to 5.75,